Well, it's time to define a marketing term. Commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub, joins us. She believes, of course, the key to profitable grain trading is building knowledge about the fundamental practices of the industry. Today, she'll help us define old and new crop. Thanks, Elaine, for taking the time with us. Those who are farmers generally have a pretty good idea what old and new crop might be. What kind of definition do you have?
Well, it really is just a very literal description, right? The old crop is the crop that has been grown, it is in existence, it's the dry grain sitting around in bins, and the new crop is the upcoming crop. So anything that will be planted this spring going forward into the fall. Um, so that's really all it is. It's just a description of two different crop years because these are annual crops and there's only one per year.
And in marketing terms, these can be laid out in the futures by contract?
Yes, absolutely. And this is where it becomes critical to pay attention to it, is if you're trading these futures contracts, you really need to know which crop you're trading. 2013 is a really great example. So the March 2013 contract, which is the most heavily traded contract right now, for instance, that's reflecting the supply and demand of grain that was grown in 2012. That's an old crop contract. But when you look forward into the September 2013 or especially the December 2013 futures contract, now that's a reflection of the crop that will be grown in 2013. And so the supply and demand for that is completely different. I mean, we could have all kinds of corn be grown in 2013. We could be up to our ears in grain by the time that comes around. And for now, we are, rather short-handed of the supply. So you're trading two completely different supply and demand pictures, and that needs to be kept straight.
And this also puts us into the marketing year, which USDA uses each and every year to define the crops by year.
The thing to keep in mind here is that it's slightly different for the row crops. Corn and soybeans are marketed according to the USDA. All of their annual projections are made between September 1st and August 31st. But for wheat, the marketing year is from July 1st of the year to June 30th of the next year.
Then there are demarcations based on all of that as to what the lead month for the new crop year might be. For instance, for corn, it's December. For soybeans, it is November, right? And then for the wheat?
Well, for wheat, July is typically the new crop market. But I'll make a statement here that a lot of times the September corn contract will behave as a new crop contract because, especially in a year when early planting comes or when there's a lot of it coming up out of the south because it gets harvested earlier. And the other thing to keep in mind is that those September contracts are different than the oilseed contracts. They trade in August and November months that corn and wheat don't trade in. So things get a little different when you're trading soybeans, soybean meal, and soybean oil.
Which months, Elaine, have contracts, and how did those come to be in the trade?
Well, for the grains, the corn futures trade and wheat futures trade on the March, the May, the July, the September, and the December contracts. So there are obviously several months that don't have a corn futures contract associated with them. But then it gets funnier when you get into the soybean futures, the oilseed futures, including soybean oil and soybean meal. You have January, March, May, July, August, September, and November. So some of these are the same as the grain contracts, but some of them are different. And how did this come about? It's because the soybean plant's reproduction schedule is different. They just tend to be harvested earlier, they mature earlier, and so that's why they just have different trading patterns.
It would be nice if each of the contracts were listed as December and or November, October, January, May, July, whatever that might be. But oftentimes when you look at a screen displaying the numbers from the CME Group or the Kansas City Board of Trade or the Minneapolis Grain Exchange, there are some really goofy letter abbreviations.
Yes. And you and I look at these screens now and it's just second nature, but I try to remember what it was like starting in the industry, and I had no idea what CH13 meant. What that means is C for corn, H for March, and 13 for 2013. So it's an abbreviation system to keep track of the months because we can't have J stand for June because J could also be July or January. And we can't have, we can't have O because those could be 1 or 0. So what they've established is just, it looks arbitrary, but it's alphabetical. January is F, February is G, so on and so forth. The ones that grain traders could keep in mind would be March is H, May is K, November is X, and December is Z.
Can you spread one month against another?
You absolutely can, and that it becomes a very important thing to do with commercial traders, the grain companies and elevators that are storing grain. They need to be paying attention to the spreads. This is the differences between the prices of two given months to pay attention to how the market may reimburse them for storing it from one month to the next.
Thanks, Elaine. Elaine Kub, commodity broker, analyst, and author of Mastering the Grain Markets. I'm University of Illinois Extension's Todd Gleason.